All right. Hey, everybody. This is Rafid Fadul, founder and CEO here at Zivian Health. Excited to bring to you a webinar today with a friend of mine and his firm. And I'm going to tell you a little personal story about myself, and then I think you'll understand why I wanted to share this with the entire Zivian community. I obviously, just like everyone else on this call, worked super hard through training and then residency and schooling, all these things, and I eventually clawed my way out of debt. And then all of a sudden, I had a couple nickels, and me being the guy that I thought, well, I'm smart, I can figure it out on my own, and I realized probably too late, but maybe like not late enough. Thank God for David. That I was leaving a lot of money on the table. I was working super hard, but not really that smart once I actually earned all this revenue. And I decided one day to like not be as passive and try to actually take control of my financial picture a little bit better than I had been doing on my own, which was clearly not sufficient unto itself. And I, through a series of discovery and interviewing a lot of different firms and talking to a lot of people who target physicians, by the way, a lot of people look at physicians as like, they think we're like the dumb smart guys, right? That they can kind of take advantage of. And I was really taken aback by a lot of these people, except for one. And we're gonna meet him shortly. It's David Auer and Provident CPAs. Their approach to not just taxes, but financial management, wealth management, risk mitigation, all these things. It was a thoughtful and curated approach to helping providers and thinking through our issues. And so, I've known David for years now, and I've been a customer for years, and now, dare I say, friend. And this was, Zivian's been around for a couple of years. I kind of didn't want to share it because when like a great restaurant, you want to keep it to yourself. But I decided ultimately like it's best for everyone if we share this amazing resource. So without further ado, I'm going to give you a quick introduction about David. With more than 35 years of experience as a certified public accountant, speaker, best-selling author, business consultant, and entrepreneur, David Auer is the founder of Provident CPAs and Physician Tax Solutions. He earned his BSBA and MS in accounting from Oklahoma State University, his JD with honors from Oklahoma University College of Law. We won't judge him for being a lawyer, and his LLM in taxation from NYU. He has the personal financial specialist, the PFS designation, as well as the Chartered Global Management Accountants designation as well. And he's a certified tax planner and with the American Institute of Certified Tax Planners. And with that, super happy to have David here. I think this is going to be really, really fruitful. Just a couple points. There's a chat box here, so everyone can drop in their comments and questions. We did reserve some time at the end just so we can get through all the content, but feel free to drop those questions and we'll work through them at the end. And with that, I'm going to pass it over to another friend, Angie O'Day. Angie, I'll let you take it away from here.
All right. Thank you, Rafid. That was a great introduction to David. I would like to make a few other introductions. We have Todd Hudgens. He specializes in estate and asset protection planning. Todd is also a CPA and tax attorney with an LLM in tax. So we're happy to have Todd here today. And then we also have Bill Bennett. Bill will be contributing a bit today as well. Bill is our financial architect and financial expert. So he's very knowledgeable. So we're also happy to have him here. And lastly, I'm Angie O'Day. I'm the client success manager. So today's agenda looks like this. We've got some great things to talk about. First off, we're doing the Secure Act 2.0 of 2022. Next up, we'll do sunset of TCJA provisions. And then third, presidential candidate proposals. And lastly, 1099 tax planning case study. I do want to make a quick disclaimer just to say that everything we do to discuss today will be within the boundaries of all the law. And I will hand it over to David.
Great. Thanks, Angie. And thank you, Rafid, for the kind introduction. The feeling's mutual as far as friendship. It's always great when you are in in a business where you consider your clients your friends. That always makes it much easier and more enjoyable to go to work every day. So just real quickly before I jump in, I'm going to give you a little bit of a history of where we've been over the last couple of years with some of the tax law changes that are still taking effect, even though Congress passed these laws a couple of years ago. But anyway, I would like to invite everyone, if you haven't already, to register for our upcoming webinars. So our next one we're calling Part 2, which is Financial Strategies to Reduce Risk with Bill Bennett. That is September the 15th at 5 p.m. Eastern Time. Matter of fact, all of these are going to be at 5 p.m. Eastern Time. Part 3 is with Todd, who's also on this call, Estate Planning for Healthcare Providers. And then Part 4, we're going to have a special guest in the private insurance space on October the 30th to talk about how we've come up with a strategy this summer to combine the benefits of Roth retirement accounts, which you'll see here in a few slides that they are being really encouraged and pushed by Congress, so we'll talk a little bit more about those changes here shortly. But then how you combine that with what I call it a tax unicorn. So some people don't think unicorns exist. Well, I would submit for your consideration that they do in the tax world in a very limited situation, and that is when we can combine the benefits of a Roth retirement account, which gives you tax-free income, with mitigating risk in the form of having an interest in a private insurance company. So we'll look forward to having everyone hopefully on those webinars. Even if you can't attend live, go ahead and register. There's the QR code register form, and you'll be sent a copy of the recording with follow-up instructions if you'd like to schedule a call to talk more. Well, let's do a little bit of a history, and that is in a bill that came out a couple of years ago called the Secure Act 2.0. This is in particular a certain division of that bill that applied to mostly around the area of retirement plans. So this was, if you notice the trend of what's happening with a lot of these tax bills, they are generally trying to broaden the net of allowing more flexibility, more ability to put money away in retirement that is eventually going to be tax-free, if you leave it in there long enough. So anyway, just real quickly, just go through a couple of these bullet points that are important. One is for those of you who had heard about syndicated conservation easements a couple of years ago, they were a hot topic. There were a couple of abusive cases that came out where valuations were, artificially inflated the charitable deduction that taxpayers would have. So it's now codified in the Internal Revenue Code that the maximum deduction you can now take on certain conservation easements, not certainly if you're a rancher or a farmer or you own land outright, you're not subject to this limitation. But if you invest in a syndication that offers a conservation easement charitable deduction, that deduction is now limited to 2.5 times the amount of the investment. So in other words, you're pretty much just going to get your money back, assuming you're in the top tax bracket. Required minimum distribution age went up gradually last year. It's scheduled to go up another couple of years by the year 2033. And then the penalties on if you missed your required minimum distribution from being fairly punitive at 25% now is 10%, but only if you correct that minimum distribution within a 2-year time period. Employee matching non-electives contributions in 401ks, 403bs, and 457 plans can now be made in the form of Roth contributions. Again, part of the movement to make Roths much more attractive. The idea, the policy there is Congress is, to the extent the taxpayer is willing to give up the deduction of putting money away in a tax deductible account, Congress is allowing whatever that retirement account then grows to the extent that it's in a Roth, to come out potentially tax-free in retirement. A little bit more flexibility there. If you're a sole proprietor and you have 1099 income, you have now all the way up into the due date of your tax return, including extensions, to be able to to make that deferral. So before that was that deferral had to be made, or that plan had to be adopted by the end of the calendar year. Anyway, going all the way down to again talking about expanded Roth options, you can now put you can open your simple IRAs or SEP IRAs and make part or all of it in Roth contribution as well. You can make distributions directly from IRAs. These are traditional IRAs over to charities up to $100,000 a year, and potentially also fund a charitable remainder annuity trust or unit trust, or a charitable annuity directly from IRA directly to that charity or that charitable trust. And then if you have expenses related to birth or adoption, or in limited cases domestic abuse, you can take out penalty-free distributions from your retirement plan of up to $5,000 per year. Those were the rules that came into effect a year ago. So if you haven't seen those, we're now those are now permanent law going forward. What started this year is you no longer are required to take required minimum distributions from Roth 401ks or Roth 403bs. So again, these are making those type of plans, especially for those people who otherwise would not want to take a required minimum distribution out of a Roth account. Now they don't have to, as long as that money is in a Roth 401k or Roth 403b. Catch-up provisions. If your income is over $145,000, and that'll be indexed for inflation, they're required to be treated as Roth contributions. Employers can now allow student loan payments to be made in lieu of making contributions into 401, 403bs. So that makes it a little bit more attractive for those of us who still have student loan payments, and we're trying to get a deduction for that in lieu of having to being required to fund a 401k or 403b. 10% penalty would not apply in a limited situation where it's an emergency, up to $1,000, as long as you repay that within 3 years. And then non-highly compensated employees can defer up to 3%, lesser of 3% of their compensation, or $2,500 for an emergency into an emergency savings account. So again, a little bit more flexibility, just to help you have a few more options to get money access to your 401 or 403 or 457 plan without having to pay penalties in the event of an emergency. And then something for those that's beneficial to several clients who have been funding 529 plans for their children. As long as that 529 plan has been in existence for at least 15 years, and you no longer need it for your children's education, you can now slowly convert that over to a Roth IRA. As long as you don't roll over more than what you otherwise could have contributed to a Roth IRA in that year. And the only other limitation is that you could not have been making contributions in that 529 plan for at least the last 5 years. So those are the rules that'll take effect. Again, most of these are retirement planning related in 2024. In 2025, catch-up contributions for 401ks and 403bs will go from $7,500 to $10,000 a year, $5,000 or more if you do a simple plan. Index for inflation after that, but it's limited only for investors that are between the ages of 60 and 63. So it's a very short window of people that can move up to that extra catch-up contribution. But everyone else up to that's outside of that age group, are subject to the previous rule. Also, certain employers who start retirement plans must automatically enroll employees and contribute it up a minimum of 3% of salary deferral and up to 10%. However, employees can opt out. So there's an automatic inclusion now for employers that have fewer than 10 employees or in business less than 3 years. That amount will increase 1% each year thereafter. So anyway, those employers who adopt those plans after 2022 will be subject to those rules if you qualify as a small employer. And then you can also now distribute up to $2,500 a year to pay for long-term care insurance premiums, also without penalty. So those are some of the rules that are going to happen next year. So that was the the 2.0 Act, the Tax Cut and Jobs Act of 2017. I'm sorry, of the year 2017. These rules came into effect starting in 2018. There's going to be several things that are phasing out. One that started last year, which is bonus depreciation for those of you who have business income and you've been able to expense or claim bonus depreciation on equipment or vehicles, or if you owned investment real estate, possibly getting a cost segregation study where you were able to claim accelerated appreciation on your real estate investment or purchase price. That is slowly getting phased out. Starting last year, it was 80%. This year, 60, 20 or 40, and then it'll go down at the end of 2026. After 2026, it'll be zero. That doesn't mean you can't expense or depreciate your equipment. Your property. It's just now going to be limited to either the traditional depreciable lives or being eligible to claim Section 179, which was in existence prior to 2018, but bonus depreciation has been more popular over the last couple of years. So again, starting in 2026 is when the Tax Cut and Jobs Act will fully sunset. So the current income tax rates that were reduced starting in 2018 will expire. That means the rate will jump back up to the top rate being 39.6%. The standard deduction will double until 2026, and then we'll be back to the itemizing deductions. And with that, we'll have personal exemptions back. So for those of you that are a little older and you may remember personal exemptions, now we don't have any personal exemptions for you, a spouse, or your dependent children, but those will come back in starting in 2026. And then child tax credits will expire. I'm sorry. They won't double. They won't be double. They'll go back to what they used to be, and which will be $500 credits. And again, this all depends on what the new Congress decides to change next year. So these are the laws that are currently in effect. One of the benefits that may come back that people have missed was since 2018. You have, if you did itemized deductions, you were limited to deduct no more than $10,000 of combined state individual income tax or property tax. That has somewhat been mitigated in most states by if you own or have a pass-through income from a business. You've been able to make, in many states, a pass-through entity election to be able to pay that state income tax, not property tax, but state income tax from the pass-through entity, and be able to deduct it 100% as a business deduction as it relates to that, the state income tax on that share of income. So that'll all go away in 2026. We'll have an unlimited amount of state income, individual income tax, or property tax. With that said, itemized deductions will they used to be phased out as income increased. That will come back into an existence in 2026. The alternative minimum tax reduction will expire. The Section 199, which is a 20% deduction up to certain types of income in limits of 20%, that'll expire. That's been very popular. That was basically a free 20% deduction on qualified business income if you had the right type of income coming through. And then something that Todd will talk about in more detail here in two more webinars is the estate tax exemption. Will go back down to what it was prior to 2018, which is back down to $5 million indexed by inflation. So we're estimating that to be somewhere in the $6 to $7 million range. So what that'll cause a lot of our clients and other taxpayers to need to update their estate planning documents just to make sure that you're mindful of whether or not you're in that window of paying an estate tax. Estate tax is 40%, so it's certainly something that can definitely deplete your net worth if you're not mindful of it. So those are some of the sunset provisions. What I'd like to do, which is this has changed a little bit because the candidates, when we did this webinar a couple of weeks ago or months ago, the candidate was still President Biden. So now we have candidate Harris as well as Trump. What I'd like to do is just talk about the differences between what they're proposing currently. And again, presidential candidates can indicate, what their wish list is on tax changes, but it takes an act of Congress, both by the House and the Senate, to actually for these changes to become law. So just keep that in mind, that none of this is guaranteed just because one of these candidates wins the presidency. So as it relates to candidate Harris, she's proposing that the net investment income tax go from 3.8% up to 5%. And that the surplus Medicare tax, which kicks in if you're single at $200,000 of business or W-2 income, $250,000 if you're married filing joint, that surtax, and this is above and beyond your share of FICA and Medicare tax, as well as your self-employment tax, and on top of your federal income tax. That's proposed to go from 0.9% to 2.1%. Like I mentioned earlier, the top rate and it's already scheduled to do this anyway in 2026. But the income amount, candidate Harris proposes that 39.6% rate will kick in after $400,000 for single filers and $450,000 for joint filers, and then the sunset of all of the changes starting in 2026 will continue for taxpayers under $400,000 of income. So the list of items that I had just mentioned on the previous slide that were scheduled to sunset in 2026 will continue for those lower income taxpayers. She's proposing that the ability to contribute to retirement will be limited for high income taxpayers that already have large IRA balances or retirement plan balances. We don't yet know what constitutes a large balance, but anyway, that could be a change that happens. And then 1031 exchanges, which right now are unlimited amount of gain that you can defer if it's in real estate or oil and gas. That'll be limited to $500,000 per transaction. So that's candidate Harris's proposals as it relates to individual income tax. Former President Trump's changes would be that he would make the sunset. It would eliminate the sunset of the Tax Cut and Jobs Act, and he'd make those permanent. So we would continue with what we will have in effect next year on beyond 2025. Also, he's looking at ways to replace some of the income taxes with increased tariffs for goods brought into the U.S. And then, as you may have seen in the press, both candidates actually have verbalized that they would exempt tips from income tax. So those are the candidates' proposed changes as it relates to the individual income tax rules that we have on income. As it relates to credits and deductions, exemptions, candidate Trump proposes no changes in that area. Candidate Harris would make the child tax credit fully refundable on a permanent basis, increase the child credit from $2,000 to $3,600, and continue it on at $3,000, which it's eliminated for older children, but she would propose extending it on for older children in the amount of $3,000. Increase the earned income tax credit for workers without having necessarily to have qualifying children. She would make that on a permanent basis, and then expand the premium tax credits on a permanent basis as well. So those are the changes on the credits and various deductions and exemptions. Capital gains and dividends taxes, this is going to be quite a big difference here with candidate Harris. She's proposing that any long-term capital gains and qualified dividends, if your taxable income is above $1 million, so that is all of your taxable income, it's not just capital gain income, would be taxed at whatever the ordinary rate is, which at that level of income would be that 39.6% rate. Plus, depending on if her proposal on the net investment income tax becomes law, then that would add another 5% on top of the of the ordinary tax rate. She would also propose taxing unrealized capital gains at death. So this is where normally we get a step up in basis, or the heirs that inherit property get a step up in basis with no limit at the end of death. Now there may be an estate tax depending on how large the estate is, but at least there's no capital gains tax currently, unlimited all the way up to the fair market value. She would propose that that would be taxed at capital gain rates above 5 million or 10 million for joint filers. And then there'd be a minimum effective tax rate of 20% on unrealized capital gains. This would be a significant hit to a lot of high net worth families above $100 million, where they would have to pay 20% even on if they lack the liquidity to be able to pay the tax on any appreciated capital gains above that $100 million. So again, a lot of things have to happen for this to become law. But that's how capital gains and dividend taxes could change depending on who gets elected and what Congress does. In the area of corporate taxes, candidate Harris proposes raising the flat rate, which is currently 21%, up to 28%. And expand, which this would affect a lot of our clients who have S corporations. She proposes to expand the net investment income tax. Again, that's what now is 3.8. She's proposing 5%. That would now apply to all non-passive business income. So income from S corporations, partnerships, investments, those type of investments, which most of which are not subject to the net investment income tax. She would propose that would now be subject to that 5% additional net investment income tax. And then candidate Trump proposes to lower the corporate rate just 1% down to 20%. So want to also invite everyone, we won't take up time on this call, but I did a fairly extensive case study. It's available on YouTube if you'd like, that compared a situation where somebody was going to get a 1099 income, which versus a W-2 of the same amount, and all of the low-hanging fruit things that taxpayer could do if they had the right situation where they got 1099 income and set that income up through a series of different tax strategies. So encourage you, those of you who either currently receive 1099 income, to watch the case study just to see if there are any additional things that you might be able to be deducting that you aren't currently. If you are stuck in the world of W-2 income, and if you do have the ability to either get part of your compensation in the form of 1099, or if you have a side gig or another business opportunity where you get income where there could be some tax planning opportunities available, I'd encourage you to watch the video, and if there's anything we can do to help you mitigate or minimize your tax burden, we'd be happy to have that conversation. So let's move into next steps. So Angie, I'm going to turn this part back to you.
All right. Thank you, David. So going into what next steps look like, I just want to lightly cover what our strategic wealth system model looks like. We work in kind of a building block system here with tax minimization, moving into an area where you feel like you have control of your money via tax planning. And then lastly, the most exciting part, the financial independence side of this. So that is our short and long-term goal, hopefully, to financial independence. And then we do have the book, The Richest Doctor, and another slide or two, I will dive into that and how you guys can access that book. So what does our process look like? When we partner with a client, we feel it's important to have a nice process in place so we can have a successful journey with tax planning. Starting off with the strategic tax blueprint, I welcome anyone to schedule a call with me, and I will also cover that later on how to do that, so we can talk about what that strategic tax blueprint looks like and how we can start getting you on a nice tax journey. And then we move into onboarding and implementation. So after your blueprint, if we move forward with an engagement, that is the very first and very important step with onboarding. And then lastly, we move into year-end tax planning. So if you have not met with me, I would love to meet with you to have a 30-minute introductory call. We can, dive into your current tax situation. I can tell you a lot more about what we do, and hopefully we can align perfectly. I think there is going to be a link in the chat to schedule with me. You can also scan the QR code as well to schedule that call with me. I hope to meet you soon. So we will wrap it up with questions. Hopefully we have a lot to cover. We do have a question here. Do you think the tax on unrealized gains, do you think the tax on unrealized gains will deter private investment and or innovation?
Well, I think I can answer it in the opposite. I can't. I think private investment will always be there, but I think now what you'll have is people having to set aside capital, as they start, getting appreciation or their investments start going up. That they're going to have to be mindful that it's going to require them to maintain some liquidity on the side to have to pay that tax when it does occur.
So far, that's all we have. I do want to make note, everybody, that there is a link to look into David's book, The Richest Doctor. So I believe you can download the first few chapters for free if you want to look under the hood and see what it's all about.
I actually had a question from one of our nurse practitioners who couldn't make it and asked that I asked the question on her behalf. So as her collaborating physician, I decided I would. She wanted to know, and this is a tough kind of general question, but top 3 bullets of financial planning and kind of tax strategies for someone in the range of kind of like low 6 figures, who is primarily a W-2 is her concern. So top 3 bullets was any suggestions there? Again, I know it's kind of like a vague catch-all question.
Well, in the low 6 figures, as painful as paying taxes are, the tax rates currently are relatively low compared to those that are subject to the top tax rate. So, and again, after depending on what happens in Congress, if those top rates kick in at 400,000, then definitely a lot more people at the higher income level are going to be doing proactive tax planning rather than just sitting back and taking their lumps. In the 100 to 200,000 range, if most of your income is W-2, then you're really limited to things that you can deduct, which is going to be largely on Schedule A. So, not that I'm a fan of this, but having mortgage interest, property tax, all of those things will be deductions against that income. To the extent that you are W-2 and you have employer provided benefits, whether those are retirement plans or anything that you can get in lieu of more income, then definitely take advantage of those. So, but your hands are mostly tied just being a W-2. You can always, invest in a side business. There's limitations on how much you can write off depending on how much you participate in those investments. But, having a side gig or a side investment that might be able to either shelter income such as rental property, or if you are more actively involved, be able to generate losses that could offset some of your W-2 income. But at the end of the day, I would say the vast majority of the tax law, probably hovering probably in the high 95% range of the Internal Revenue Code, is really written to the group of taxpayers that are either investors or business owners. That's where most of the benefits are under our tax system. So to the extent that you can look for 1099 income opportunities, that's where the door gets open to be able to do a whole lot more to minimize your tax burden.
Great. We do have another audience question. How do the various potential 2024 tax policies impact the treatment of charitable donations made by physicians or healthcare practices?
Well, the charitable deduction rules have not been, affected legislatively. Generally speaking, for the last several years, that is considered to be, somewhat off grounds for Congress or the IRS to deal with, is because that's such a significant lobby. Charitable contributions, as of right now, have not been really targeted to be reducing those, other than the one additional expansion that I mentioned, where you can make charitable contributions directly from a retirement plan into any number of various charitable structures or organizations. The limit, the amount that you can deduct is generally going to be limited by the type of property that's contributed, as well as what your adjusted gross income is. So there's various percentages of limitations of your adjusted gross income. And it also depends on what type of property, whether it's appreciated property or cash that you're contributing. And then the rules related to an excess deductions, if you go beyond those percentages of adjusted gross income, are still intact. The same rules that we've had for several years. So those haven't yet been impacted by any potential legislative changes.
All right, and we have one more. With increasing taxes, when should I implement a tax plan?
My suggestion is at the point that it becomes painful. So it's kind of like taking medicine. You try to maybe go without it as long as you can tolerate it, but at some point when it becomes painful and you start seeing that, on top of not only having to pay income tax, when you buy something, you're generally going to be paying sales tax. If you buy real estate, you're going to be paying property tax. And then like we just talked about a little while ago, if you accumulate too much during your lifetime, you might either pay a capital gains tax on the appreciation and or an estate tax. So those are two taxes that might hit you at the end of your lifetime. So unfortunately, over the last 100 years, as tax legislation has increased, Congress has also identified, that there's lots of different ways that they can collect their tax, and at this point, it's pretty much on almost all of our activity that they collect not only tax at the federal level, but also at the state and sometimes local levels too. So we have, as a generation, we've generally become numb to that. But at some point, when the pain point gets too high, that's and it's really on an individual basis. That's when you should try to take action.
All right, we have another one. I think everybody likes what you're talking about today. All right. So can you briefly mention several strategies that 1099 people should consider?
Well, they're detailed out in the case study on the YouTube link that I was providing. But a couple of, depends on the client, but you might be able to set your 1099 income up through an LLC that, first of all, you might want to consider having that entity taxed as an S corporation. That's going to allow you to control somewhat the amount of self-employment tax you otherwise would have to pay on that 1099 income. On top of that, and obviously you as corporations have to pay their shareholders generally what is described as a reasonable compensation. So that is certainly, the temptation would be to not pay yourself any compensation, therefore not have to pay FICA and Medicare tax. IRS unfortunately says that zero is not considered reasonable if you have positive net income. So you would have to pay yourself at least a reasonable salary and pay the FICA and Medicare tax on that. If you did that inside of an LLC or an S corporation, that payroll tax would be an additional tax deduction. So that is somewhat of a mitigating circumstance. On top of that, you might have a home office deduction based on the square footage of your home that is used exclusively as a business office. You might take advantage of what some people call the Augusta rule, which is renting your home to your business for up to 14 days. That is considered any rental income under 14 days or less is not considered taxable income. It's a de minimis amount by the IRS, but you could still deduct it possibly as a business. Putting your children on payroll, employing your children through your LLC is another opportunity. Paying them an age-specific wage and tracking that what they do for your business could be another way. And obviously, putting them on payroll to the extent that you can pay them up to the standard deduction amount, which currently is $14,600. That has the effect of shifting that income from your top marginal bracket down to a zero tax bracket, assuming they didn't have any other income. And then by giving them a W-2, you now they're eligible, since they have earned income, to possibly fund a Roth IRA for their future college expenses, which could be another option to putting money away in a 529 plan. On top of that, you might there's medical expense reimbursements that you can have, and then just if you do work long shifts, considered 12 hours or more, generally you are eligible for a per diem daily allowance. So depending on whether you live in a high cost of living city or low cost of living city, it allows you to claim a standard per diem allowance that may be greater than what you actually are out of pocket. So a couple of those. Now again, that's available whether you're just pure 1099 running it through a Schedule C or you're an S corporation. But at least that's something that generally you're not going to get if you have W-2 income. So those are the ones that come top of mind. And again, I encourage you to watch the case study or the recording and it'll give you a couple of other options.
Okay, we've got another one. Is it worth recommending to try a backdoor Roth IRA, specifically with the potential tax increases coming?
Well, that's the $1 million question, if you will. That converting or funding a Roth IRA is really with the hope that you're giving up a tax deduction today in exchange for tax-free income in the future. So if tax rates stay the same, generally putting money in a tax-deductible retirement account isn't going to save you any tax money. You get the illusion that you're accumulating more inside the tax-deferred account, but at the end of the day, you're going to end up having to pay the tax at that same rate. So you're really just kicking the can down the road. Where you by putting money in a Roth IRA, you're betting that tax rates, so that if you are giving up, being willing to pay the tax today, your hope is that tax rates will go up, or not that you hope, but that you're betting on that rates will go up when you retire, so that it's better that you had to pay a little bit of tax today, but you saved a lot more tax if the rates go up when you retire and take that money out.
Okay, and then we have another one.
And how about we allow one more, and then we'll wrap things up.
All right, sounds good. Okay, are the bank interest profits from business banking accounts, interests, CDs taxed more than the personal banking accounts?
Well, it depends on what type of business entity it is. So a C corporation is taxed at a flat corporate rate, federal rate of 21% currently. If it's a pass-through entity, partnership or S corporation, then that income just flows through to your personal return. So at the end of the day, you're paying the same income tax rate on your individual return, whether it's passed through on a Schedule K1 or if you just earned that interest in a normal taxable bank account individually.
Okay, good. Thank you, David.
All right. Well, again, thank you everyone for allowing us to share some tidbits and tips on tax planning this year. Again, do recommend that you sign up and at least register and hopefully watch our upcoming webinars. I think each of them will increasingly be more and more valuable as we get closer to the election, just to give you some ideas on things that you might want to consider doing. So again, thank you everyone for your time today.
David, thanks so much. Angie, the rest of the Provident team, super excited to have you. I feel like every time you guys talk, I end up feeling dumber and I have to ask more questions. So that's always a good sign. I'm learning more every time you guys are chatting. Everyone who carved out time today, thank you for attending. Hope this was useful and you derived as much benefit as we did. And we will be circulating for everyone who's registered. Obviously, we're going to circulate the video of this and also the upcoming webinars that we're going to do as a continuation of this series. So thank you again, everyone. Have a great evening.